everyone, welcome to Oliveboard. Hello bankers, a very warm welcome to everyone here. So in today's lecture, first of all, I hope you all are fine and doing well. And also in today's class, we are going to start our module C. We will discuss all the top questions from the module C. I hope I am visible, I am audible, and my screen is visible to all of you. So a very warm welcome, and we are going to start our module C. We will see all the top most important questions in the module C, and we will try to cover as many questions as possible in today's session. Okay, so let me share my screen. Everything is visible. I am going on the slide first. Okay, so as you know, this module based on the treasury management. So first we have to learn, we know the what is the meaning of treasury management, what is the meaning of treasuries here. Okay, so I am hoping that my screen is visible. Okay, so this treasury function is focused on the funds management. In this we learn, as bankers you learn that how to manage the funds, which involve like maintaining all the sufficient cash balances which are helping in meeting daily operational needs, and also it deploys the surplus funds which are generated from the business activities, and also there are some sourcing funds which addresses temporary cash flow gaps. Okay, now if we talk about in the context of bank, if we think as a bank, treasury is also responsible for fulfilling all the reserve requirements, such as holding the minimum cash balances which is mandated by the RBI, but with the mandated the CRR with the RBI, and also investing all the funds which comply with the statutory liquidity ratio. So here is the first question: which statement is incorrect regarding ECB, external commercial borrowings? And we know that what is the meaning of external commercial borrowings. This is type of a loan in a foreign currency that Indian companies and public sector undertakings take from non-resident lenders. So just read the all options given here and then try to give the answer that what is the meaning, what is incorrect. That means three options are correct in regard of ECB, one option is incorrect here. First option is saying that Indian companies can borrow in global markets from the banks which are using ECBs. This is correct. Why? Because we know that Indian companies are allowed to raise the funds through the external commercial borrowing from the foreign sources. Okay, then second option is here saying Indian companies can borrow up to US dollar 750 million. We can say this statement is also correct, but it is important to note that the specific borrowing limit of US dollar 750 million is applies to the automatic route, where no RBI approval is required for the certain condition. And for the borrowings above this limit or outside the automatic route, RBI approval is required, may be required. We can use the word may be required. Third option is saying in ECB, minimum average maturity up to period of 10 years is allowed. So this statement is also correct. Why? Because here ECBs are basically subject to the maturity requirements. Okay, ECBs are basically subject to the maturity requirements but with a minimum average maturity of 3 years of certain borrowings and up to 10 years in some cases. And if we talk about the point D, that is the for point here, what is D option is saying, for the point, whatever the point are given, A, B and C, Indian companies need to take approval from the RBI. See, this is incorrect. Why? This is incorrect. This statement is incorrect because under the automatic route, Indian companies can raise the ECBs without needing any type of prior approval from the RBI, which provide they can meet some type of certain conditions. And for amounts above the threshold or the specific types of borrowings, approval may be required from the RBI. So now you know in what cases we need the approval from the RBI, and other three options are correct in regards of ECB, but D option is incorrect. So we have to mark D option. Next question, which of the following is not a type of security? Which of the following is not a type of security? See, let's talk about option A, held to maturity, which is placed under the banking book. This is This is correct. This is correct. Why? Because held to maturity securities, these are the debt instruments that basically a company intends to hold until maturity. These are typically classified under the banking book and they are valued at some amortized cost. But if we talk about the held for trading, placed under the trading book, basically this statement is also correct. Why? Because held for trading, HFT securities are typically bought with the intention to sell them in the short term for some type of trading purposes. They are classified under the trading book and are valued at the par value. Third option is saying that AFS placed under the trading book. This statement is also correct. Why this statement is correct? Because we can say this statement is correct, but little bit misplacement is there. What? Like available of sale securities are typically placed under the banking book rather than the trading book. Rather than the trading book, I am saying here, AFS securities are not necessarily held for trading but can be sold or transferred depending whatever the market conditions are there. They are valued at fair value with unrealized gains or the losses recorded in the equity. Okay. And the option D is mark to market placed under the banking book. If we talk about this option here, this is incorrect. Why? Because mark to market is not a classification of security. This is refers to the practice of basically we can say valuing the assets which are based on their current market price. Securities in the trading book are marked to market, not those in the banking book. So we can say that D statement is not a type of security. That means option D is correct. Understood? Third question is there. RBI may absorb liquidity by selling the securities in the market and may infuse liquidity by buying back the securities from the public. That is called, four options are given. OMO. Very good, Shalaka sir. OMO. Okay, let's discuss. Here the answer is OMO because this is related to this is called open market operation. This is the correct term. OMO refers here buying and selling of the government securities in the open market by the RBI. Basically, it is a tool which is used by the central bank to manage the liquidity in the financial system. When the RBI wants to absorb liquidity, it sells the securities, and when it wants to inject the liquidity, it buys the securities from the market. So the correct answer is OMO. If we talk about the incorrect option, first one is auction. You know that auction is what? When the government or RBI sells securities to the public. And if we talk about the bidding, bidding refers to the process of offering a price for the securities in a auction. But it is not a term which is used for the specific activities, whatever the question is asking. And security discounting, this term generally refers to the practice of purchasing securities at a price lower than the face value. Okay. Next question. Under MSF, the eligible entities can avail overnight up to what percent of their net demand and the time liabilities outstanding at the end of the second preceding fortnight. Fortnight, we know that 14 days of time, so you can tell me here the correct answer. Yes, here this is the direct concept. 2% is the correct answer. Very good, Shalaka sir. So, clear? Next question. The CD should not be bought back before a minimum period of dash days from the date of issue. 30 days, 14 days, 7 days, 28 days. CD, that is a certificate of deposit. This is a short-term money market. So here the concept of CD is clear. It is a basically short-term money market instrument which is issued by the banks and has a minimum holding period before it can be bought back or redeemed. And according to the regulations, a CD should not be bought back before a minimum period of 30 days from the date of issue. So the answer is here not 7 days. This is incorrect because the minimum period is not 7 days, 30 days. "30 days" is the correct answer. Next question. The T-bill, Treasury bill, like other government securities, is in an electronic form and is to be held in SDL account, demat account here, or the government security accounts, or technologies account. If we talk about the treasury bills, like other government securities which are issued in the electronic form and are typically held in SGL account, that is subsidiary general ledger account. These accounts are maintained by the RBI. And what is the purpose of maintaining? For the purpose of holding and setting the government securities. Okay, so this is correct here. Because these T-bills and the other government securities are typically held in SGL accounts which are used by the financial institutions, which includes banks and the primary dealers, to hold such securities in the electronic form. And if we talk about the demat account, a quick review about the demat account. While government securities can be held in a demat, which is applicable for the securities that is generally held by the retail investors, but these T-bills specifically held in the SGL account. of institutional investors. And if we talk about the government security account, these term is not commonly used in the context of holding the government securities. And the option 4, this is basically refers to the specific technology service provider, but not the account for holding the T-bills. That's why A option is correct here. A combination of spot and forward transactions is known as, four options are given. Combination of spot and forward transaction. This is called swap. Why? Because swap is the combination of spot and the forward transactions. In a swap, two parties are here, which are who are basically exchanging the cash flows or financial instruments, whatever the agreed upon terms. And a common type of swap involves spot and the forward transactions. In a foreign exchange swap, where one party buys a currency on the spot market and the simultaneously we can say sells it on the forward market, or maybe reverse, vice versa. Swap. So this is the correct combination of spot and forward transaction is called swap. Future is a standardized contract where we're buying and selling of the assets at a future date for a price agreed, whatever the price agreed. Option basically we can say is a financial derivative that gives the buyer the right but not the obligation to buy or sell an asset at a specified price. And here if we talk about the forward transaction is basically also a contract where buying and selling of an asset at a future date for a price agreed today, but it is not a combination of spot and forward transaction. So the correct answer is here option A. The process of integrating domestic market with the global market characterized by the anti-dumping duty, free capital flows, maximum regulatory intervention or decreased value of export. See, if we talk about the process of integrating with domestic market with the global market, it is primarily characterized by the movement of capital across the borders. Okay, this is known as free capital flow, which allows for the movement of financial resources, investments and the capital, but with heavy restrictions. The integration of domestic market with the global market, it promotes economic growth, increases the investment opportunities and also facilitates the international trade. So we can say here option B is correct. The process of integrating domestic market with the global market characterized by the free capital flows. Okay, understood. If you liking this session, kindly give the like by thumbs up and also subscribe to the channel. This is as per your wish. Okay, so we will now start our next question. Read the question carefully, read the all options and then give the answer. See, here we have to tell the initial focus of the treasury function. And we first continue with the what are the functions of treasury, integrated treasury here. First one is meeting all the reserve requirements. Reserve requirements means CRR and SLR. Okay. Next one is global cash management, efficient merchant services, and also here risk management, assisting the bank management in the ALM. And if we here read reading the all options, option A is saying that maintaining sufficient cash balances for day-to-day daily needs, deploying surplus funds and sourcing funds for cash flow gaps, fulfilling the reserve requirements including cash reserve ratio and statutory ratio. This is also the function of treasury function. First one is also the function of treasury. Third one is also the function of liquidity management viewed as a service center. Yes, that means here we can say all of the options are correct. D, all of the above. Understood? Okay. So in your examination, there are some questions maybe come without options. In CAIIB, we see that type of questions. So try to give the answer of this question. What is the meaning of this answer of this question? The treasury function encompasses fund management, investment, forex operations, trading, risk management services in a, if we talk about here, these type of treasury management activities encompasses here fund management, investment, forex operation, trading and risk management services, but in a multi-currency environment. Okay, multi-currency environment. This is the correct answer here, multi-currency environment. Functions of treasury. Following are the functions of treasury. And I told you about this, about the treasury's function here. Basically, repeating one more time, it includes meeting the reserve requirement, that is CRR and SLR, global cash management, efficient merchant services, risk management, managing the market risk of the bank entity, and also assisting bank management in ALM and fund transfer pricing. It included in the integrated treasury functions. So we can say all of the options are correct. Now treasury management operations primarily deals with the treasury management operations primarily deal which of the following: short-term fund flows, long-term fund flows, or both of them, none of them. So here, if we talk about the correct answer, basically treasury essentially deals with the short-term funds. Essentially deals with the short-term funds. Short-term funds means with less than 1 year maturity, with the exception that as a part of the SLR requirement, investment in some type of securities which held to maturity exceeding 1 year. So we can say here option A is correct. Okay. Moving to the next question. Which of the followings are included in the treasury management activities? If we talk about the treasury activities, it encompasses, I told, fund management, investments, forex, trading and the risk management, and we can say these are the important, means you can see this is the question type which is dependent with the on the options, and this is the question type you the question can be asked without option if the form will be like this. Okay, now integrated treasury, let's take a quick review. This is a banking setup which refers to the integration of the money market, securities market, foreign exchange operation. As the name is integrated treasury, that means integration of money market, securities market and the foreign exchange operation. And if we talk about in the Indian context, Indian treasury is a direct outcome of the reforms in the financial sectors. Okay, and rupee, we know that are freely convertible on the current account and also convertible on the capital account. And thanks to the RBI who introduced some major types of relaxation. This is the globalization. Let's see, globalization is one of the important topic. It refers where the domestic and global market are interacted, and here also domestic markets are integrated with the global markets. Okay, so the question is here, how do portfolio investment and direct investment differ in the terms of their impact on domestic markets, and what does globalization play in facilitating these types of investment flows? Four options are given here. We know that globalization means interaction between the domestic and the global market. It is a process of integrating the domestic market with the global market, which is characterized by the free capital flows and minimum regulatory interventions. So if we talk about the correct option, I think option A is correct because portfolio investment affects the short-term market liquidity, while direct investment impact long-term economic growth through the infrastructure development. Globalization, I told you here, free capital flows, interaction between domestic and global markets, and also here minimum regulatory intervention. So option D is correct here. All of the options are correct. What is the dealing room? Lots of question on the globalization, treasury, now the dealing room. What is the meaning of, what is the dealing room? Dealing room, which is known as the front office. We know that there are three types of office: front office, mid office, back office, which only handles the execution. Execution of what? Execution of deals. It is headed by the chief dealer, with the dealers working under him, and is directly buys and sells the securities in the market. Each dealer specializes in one of the market: foreign exchange, money market, securities market, because it is an integrated treasury. The dealers are generally familiar with all the markets. The dealer room is no way involved in the settlement process of the deals which are executed by them. So I think all the options in the given question are correct. Understood? Next question. Which of the following best describes the role of settlement in the banking operations? So, I hide myself just for your perfect view of the question. As we talk about the settlement means, basically settlement refers to the receipt and payments of amounts that are following the deals which are made by the dealers, that is sale and purchase of foreign currency, lending and borrowing, selling and purchase of securities. This is a type of a key function of the back office where all the payments and receipts must take place on value date. And maybe there is any delay uh, in the settlement would not only result in the financial loss to the bank, but payments are considered as default by the bank, severely affecting the bank's reputation. So here the question is asking best describes. So if we talk about the best description, option A is correct. Where option is saying settlement involves the receipt and payment of amounts following deals such as foreign currency transactions, lending, borrowing, and selling securities trading. So the option A is correct here. Understood? Next question. Which of the following is not a source of foreign exchange surpluses for a bank? Which of the following is not a source of foreign exchange surpluses for a bank? And here we can say five options are here. Treasury. Treasury basically is responsible for the investment of the foreign surpluses of the bank. A bank may have foreign exchange surpluses from the following sources, like a profit from the treasury operations, and also here we can say foreign currency and convertible rupee deposit with branch. Sorry, option B is here, profits from the overseas branch operation. This is also us bank may have a as a foreign exchange surpluses, and this is we can say also a source. C option is here, forex borrowings in the overseas domestic market. This is also a source. Then foreign currency and convertible rupee deposits with the branches. This is not the correct option here. So this is not a source, but float funds on the account of customer transactions, balances in the nostro accounts, funds maintained in the EEFC account. These all are the correct sources of the foreign exchange surpluses, but this D option is correct here. This is not a source. Which of the following is not permitted avenue for the banks to invest foreign exchange surpluses? Not a permitted avenue. In the last question, just read the question 2 times because I confused in this question. I clearly not focuses on this word note, so that's why just I am sharing my experience. Just see that what the actual question is saying, that is not a permitted avenue for the banks to invest foreign exchange surpluses. If we talk about option A, interbank loans with the exceeding term 5 years, banks are permitted to invest foreign exchange surpluses in the global money markets. But some of the avenues which are available to the treasury for investment of forex surpluses, first one is interbank loans, normally not exceeding here 1 year term, but mostly in overnight deposits with the domestic and global banks. So basically here this option, first option, is incorrect. Means this is not permitted. Then short term investments are here. Banks are permitted to invest in overseas in the short term instruments of high credit quality such as treasury bills, gifts which are issued by the foreign governments. Okay, and nostro accounts where float funds of the bank are parked pending utilization, customer draws. So the correct answer is option A. Understood? Which of the following of the function of the treasury? Treasury functions are basically here, uh, maintains the adequate cash balances to meet the daily requirements, and also it includes deploying the surpluses funds which are generated from the operations, and also sourcing funds to bridge the occasional gaps in the cash flow. Forex market, foreign exchange market, is the most liquidated market for the free currencies, as the free currencies like major currencies which are fully convertible like US dollar, British pound here, JPY, etc., can be readily bought and sold here. That means our option C is correct here, meeting the daily requirements. Okay. Why is the US dollar INR market described as very liquid despite the INR not being fully convertible? So, read the options again carefully. See, if we talk about the answer here, uh, free currencies belong to those countries whose market are highly developed and where the exchange controls are practically dispensed, and the currencies which are not fully convertible have some kind of limited demand, okay, and may not be traded actively, but they may also enjoy some type of high liquidity, okay, depending on the size and the stage of development of the domestic market. So here if we talk about all the options, first option is here, the low development stage of the Indian market reduces trade restrictions, which leads to high liquidity. The large domestic market or high growth rate of the Indian economy increase the liquidity. Basically, this is not being fully convertible. So here we can say option B is correct. Okay. Option B is correct here. In the context of currency exchanges, what is the typically settlement for a spot trade? So, currencies are mostly bought and sold in spot trades. Basically, the spot refers to the payment and receipt of funds in the respective currencies. Spot settlement takes place 2 working days from the trade date, after the 2 working days. That is basically on the third day. But currency may be bought and sold with the settlement on the same day. That is called the term and cash on the next day. All the exchange rates which are quoted here, which are important, which are basically for the spot trade by default, unless basically this TOD and TOM rates are generally quoted at discount to the spot rate, the rate is less favorable to the buyer of the currency. So option A is correct here. And yes, this also explained here how do the exchange rates for the TOD and TOM trades generally compare to spot rates in the currency trading. So after seeing, you can say option C is correct because these are quoted at substantial markup compared to the spot rate. So the option C is correct here. Now let's tell the here what is the primary purpose for the importers and the exporters to enter into forward contracts with the banks. Okay, so here we can say the primary purpose. Basically, Treasury make enter into the forward contracts with the customers or with the banks as counterparties. Customers, that is importers, exporters, and some others who expect the payments or the receipts in the foreign currency can cover their currency risk by entering into the forward contracts with their respective banks. So if we talk about here the correct option, first option is correct, to cover their currency risk in the foreign transactions. Second option, what entities might act as counterparties in the forward contract according to the provided uh, question. Here, basically, here we can say option C is correct because the customers of banks in the interbank market are here, we can say, act as counterparties in the forward contracts. So option C is correct. Just give me a minute. Okay, now everything is okay. So in this option we can say option C is correct. Okay. What constitutes a US dollar INR swap in the foreign exchange market? Here, spot and forward transactions are the primary products in the foreign exchange market, and the combination we know that is called a swap of basically spot and forward. A swap transaction is also described as an exchange of cash flows, buying the US dollar with the rupees in the spot market and selling the same amount of US dollar in the forward market, constitutes a US dollar INR swap. Similarly, simultaneously, purchase and sale of currency on two forward dates is also a swap. So, if we talk about the correct answer in the given options, you can read the options. Option B is correct, buying the US dollar with the rupees in the spot market and selling US dollar in the forward market. So option B is correct here. Okay. How is a swap transaction described in the terms of cash flows in foreign exchange market? Swap transaction is an exchange of cash flows. I told you about this concept. Now tell me the characteristic of money market regarding the maturity of funds. What is the characteristic feature of money markets regarding the maturity of funds? See, Money market refers to raising and deploying short term resources with the maturity of funds generally not exceeding 1 year. The interbank market is subdivided into call money, notice money, and term money market. Okay, so we can say here the correct answer, funds in money market normally have maturity over 10 years. No. Funds in money market have no defined maturity period. No. Funds in the money market mature after a period minimum of 5 years. No. Funds in money market typically mature within 1 year. Yes, this is correct. Option D is correct here. Okay, understood feature of the money markets. Which rate is widely used as a benchmark for overnight interest rate swaps and indicates the liquidity in interbank market? Which rate is widely used? That is the rate which is refers to the overnight placement. That means the funds borrowed banks funds borrowed by the banks need to be repaid on the next working day. Call money rates indicate liquidity which is available in the interbank market, and that overnight Mumbai interbank offered rate is the indicative rate for the call money, fixed the daily in the morning, uses widely and as a benchmark rate for the overnight interest rate swaps. So here option D is correct. Understood? Option D is correct. This rate is widely used. In the notice money market, for how long are funds typically transacted? Notice money, we know that under the call money market, funds, whatever the funds are there, are transacted on a overnight basis. But under notice money market, funds are transacted for a period of 2 days and 14 days. 2 days, a period between 2 days and 14 days. So option B is correct here. Just option B is correct. Okay. In the context of term money market, what is the typical duration range for fund placements? In the context of term money market, what is the typical duration range? Term money market is typically a market for the placements of funds with the banks of period exceeding 14 days but not exceeding 1 year. Typically, term money placements range from 1 month to 6 months, and the placements for the longer periods are not very common here. So the correct answer is option A, 1 month to 6 months. Okay. What is the primary method by which interest is provided on the securities which is issued by the Government of India for 91 days, 182 days and 364 days? Just try to give the answer. Very good, Shalaka sir. Giving the answer correct. Primary method, basically these are issued by the Government of India through RBI for the maturities of 91 days, 182 days, 364 days for the predetermined amount. The interest is by way of discount. So the bill are priced below 100, that are treasury bills basically. So we can say here option four options are given, and in the four options option D is correct. Interest is provided through a discount method. So option D we can say is the correct answer. Understood? What is the primary purpose of issuing that cash management bills by the government of India? The government of India, consultation with the RBI, has decided to issue some new short-term instrument. These short-term instruments are known as CMBs. That means cash management bills, to meet the temporary cash flows mismatches of the government. These in India, the CMBs in India are non-standard discounted instrument which is issued for the maturity but less than 91 days. These bills have a generic character of treasury bills. So you can read option D is correct here. Okay. Next question. What is the key distinction between FDI and FII in the context of FII investments in the India? FII investments, foreign investments, flow into India by the way of foreign direct investment, that is long term project related investments, and the portfolio investment. Basically portfolio investment, we can say the investment which is in the stock market and the debt market but for the short term gains. Foreign institutional investors, who include the investment banks and also hedge funds, market for the short term gains. Foreign institutional investors included here mainly in the portfolio investments, and also ADRs, GDRs, these are issued by the Indian companies. Yes, and also the holder of this ADR and GDR have an option to sell their holdings in the domestic markets, and they can receive proceeds in the foreign currencies. So the option we can say here, this basically FDI here involves long term project related investments, while FIIs are here focuses on short term gains through the financial markets. So the option C is correct here. This is the key distinction between FDI and FIIs. Okay. What does this mean, sir? Shalaka, sir, address temporary cash flow. What does that means? Okay, what are the limitations does the RBI impose on banks when using foreign currency non-resident deposits? What limitations? If we talk about here the ECBs, these ECBs, Indian companies can borrow in global market from the banks or issue the debt paper, basically notes, bonds, etc., with the guidelines issued by the RBI to fund their domestic overseas projects. And these foreign currency funds of banks Banks can use these types of FCNR deposit funds for the investment in the overseas market, which is domestic available for the domestic lending in the foreign currency. They are also permitted to borrow, invest in overseas markets, but with a 100% of unimpaired Tier 1 capital, minimum US dollar 10 million, which is subjected to the guidelines issued by the RBI. Banks generally use this facility to extend the short term loans, which are usually with the 6-month rollover. So, here B option is correct. So, what are EEFC accounts and how do they benefit exporters? EEFC accounts. Okay, so if we talk about EEFC account, it is a type of account that allows individuals and the companies to store foreign income but in the original currency. Okay, and also here the options are given. Let's read the options. EFC account reduces the interest rate on export related loans. EFC accounts allow the exporters, to hold earnings in the foreign currency. That is the correct answer here. EFC accounts are those accounts that also allows the customers to hold the earnings in the foreign currency. So the option B is correct here. Okay. So what is the maximum amount that can individual can remit overseas in a financial year under the RBI liberalized remittance scheme without prior approval? And we know that under the LRS there is the US dollar 2,50,000 is allowed without any type of approval, but more than that needs the approval from the RBI. Understood? Who is responsible for issuing the government securities on the behalf of the government of India? Basically, these government securities are issued by the public debt office of the RBI on the behalf of government of India. And investment being a subject in itself, we can say investment projects are investment products are available to the bank treasuries, and the subject here investment businesses is an important part of the integrated treasury and is composed of buying and selling this product which is available in the securities market. But which entity is responsible? This public debt office of the RBI. Which of the following statement accurately distinguishes corporate debt paper from government securities and the approved securities? Let me know the answer of this question. Which of the following statement accurately distinguishes corporate debt paper from the government securities and the approved securities? And also, just if you need the PDF of this class, you can tell me that you need PDF. I will provide you the PDF too. Okay. Yeah, 2.5 lakhs, but in US dollar this is 2,50,000. Great. Okay, if we talk about that corporate debt paper, that is refers to the medium and long term bonds and the debentures which is issued by the corporates and the financial institutions which are tradable. These are also referred to as non-SLR requirements securities to distinguish the corporate debt from the government securities and some other approved securities which are eligible for the meeting SLR requirements of the banks. So the Tier 2 capital bonds are basically issued by the banks and also falls under this category. So if we read the options correctly, option C is correct here. Corporate debt paper is referred to as a non-SLR securities because it does not qualify for banks' SLR requirements. What factor primarily influences the yields on corporate debt instruments and are discussed in the text? Whatever the yields on the corporate debt instruments, two instruments which are depending on the credit quality, that is basically higher the credit risk, higher the yield. Most of the debt issues have credit rating by the credit rating agencies which is registered with the SEBI. These are basically CRISIL, ICRA Limited, CARE, Fitch Ratings India Private Limited, and Acute Rating and Research Limited, and some type of information Informix Valuation and some Rating Private Limited, that is VRPL. And global ratings are also necessary for the debt paper is when issued. So the given option, we can say that here the correct option is the issuing company's market capitalization. Option D is correct here. Now tell the which of the correct is correct in the context of forward contract. Forward contract, we know that refers to the purchase and sell of a currency on a future date, and this exchange rates for forward sale or forward purchase are quoted today, hence transactions are referred to as forward contracts between the buyer and seller, and Treasury may enter into the forward contracts with the customers or with banks as counterparties. So if you read the options, you will find all are the correct for the context of forward market. Banks prefer to invest in commercial paper through Treasury because bank tends to invest in commercial paper through Treasury because here that credit risk is relatively low and limited to short period. Okay, and there is a yield on CP, that commercial paper, that is generally higher than the interbank money market, and CP being a tradable instrument, there is a lesser liquidity risk. So the correct answer is here all of the above. Okay, which characteristic differentiates the CDs which are issued by the banks from those issued by the other financial institutions? CDs, basically unsecured debts, unsecured debt instrument which is used by the banks or some other eligible financial institution. This is a negotiable instrument and generally bears interest rates higher than regular deposits of the bank. It is also more extensive to the bank and it attracts the stamp duty. And the period of maturity of the CDs are basically issued by the banks, which are of different range, like 7 days to 1 year from the date of issue. And also here they can issue CD for a period not less than 1 year, not exceeding the 3 years from the date of issue. And if we talk about the minimum amount of CD that can be issued by the institutions shall be rupees 1 lakh, and the multiples of rupees 1 lakh thereof. CDs can be issued only in demat form. So if we read the option, you will find that option D is correct. So which statement is correct? I told you recently which statement is correct regarding the issuing form, and the amount of certificate of deposit is correct. So now you can tell which option is correct. After reading all the options, you will find that CD must be issued in a demat form and also in multiples of 1 lakh. So the option B is correct here. Okay. What is repo? Repo, what is? It is used extensively by the RBI as an instrument of monetary policy to control the liquidity in the interbank market. Repo is one of the main instrument for the liquidity management under liquidity adjustment facility for the commercial banks. And absorption of liquidity is done through accepting funds from banks against the sale of government securities by the RBI, which is known as the repo transaction. So if you see here, it is a tool which is used by the RBI for open market operation. Yes, obviously, this option is correct here. Okay. Tell me the answer of this question. Just wait. I think in this question, if we read all the options carefully, it includes all the options. That means all the options are correct in this case. Yes, it involves selling a security and simultaneously agreeing to repurchase it at a future date, and it also affects the liquidity in the system. So we can say all the above options are correct. Now, in this, which of the following best describes the use of repo and reverse repo by the RBI? So repo is a securities transactions which is used for lending and borrowing the money market funds for the term exceeding 1 day to 1 year. And repo refers to the purchased securities by the RBI with a commitment to resell the same securities at a later date at pre-agreed price. So all the repo transactions are governed by the repo directions which is issued by the RBI, and repo rate affects the liquidity in the system. So here Which option can be correct? It is an extensively by Reserve Bank of India as an instrument of monetary policy to control the liquidity. So option A is correct here. What is convertible bond? Now tell me fast, what is the meaning of convertible bonds? Convertible bonds are a mix of debt and the equity, where the bond holders are given an option to convert the debt into equity at a fixed rate or during a fixed period, and the conversion price is predetermined or worked out as prevailing SEBI guidelines. The benefit to the company is that there is no debt repayment, and at the same time its equity base is strengthened. The coupon on convertible bond is generally lower than the coupon on the non-convertible bond of the similar credit standing. So we can say that here it is a mix of debt and equity. Bondholder also an option to convert debt into equity at a fixed price. And also third option is also correct there. The conversion price is predetermined. So all of the options are correct here. I am hoping that you are enjoying this session. Some important questions are, you are feeling that important questions are there for you. So if you like this session, kindly give the like, subscribe to the channel, and if you want, you can do the comments also. That good, not good, any suggestion, any feedback you want to give, just you can give. Now under the FEMA and its related regulation, when does an investment by person resident outside India in a listed Indian company qualify as foreign direct investment? If we talk about the foreign investment in India, in terms of a clause B subsection of subsection 3 of section 6 and section 7 of the FEMA 1999, this is basically read with the foreign exchange management. In this we can say FDI is an investment through the capital instrument by a person who is resident outside India, an unlisted Indian company, or 10% or more of the post issue paid up equity capital on the fully diluted basis of a listed Indian company. And here if you read the option, you will find that option A is correct. There is nothing to explain in the other options. Understood? Moving to the next question. Okay, now tell me which of the sector is prohibited for the investment by person resident outside India. Which of the sectors are prohibited? Tell me fast. Okay. If we talk about the investments by a person resident outside India is prohibited in the lottery business, which includes government private lottery, online lotteries, gambling, betting, including casinos, chit funds. Chit funds except for the investment which are made by the NRIs and the OCIs on a non-repatriation basis. Nidhi company and also TDRs. So the given option lottery is the correct answer. What is the primary function of GDR? Primary functions of GDR. GDRs represents the receipts that entitle the holder to convert into specified number of equity shares of the Indian company, and the receipts are issued by the depository abroad and are traded in the overseas market. They are negotiable receipts. And the underlying shares, which is issued by the Indian company, are held by the Indian custodian on the behalf of overseas depository. They are denominated in the foreign currency. So here in the given option you can read the four options. Primary function is to basically enables the conversion of receipts into equity shares of an Indian company. That means option B is correct. And here, who holds the underlying shares for GDRs on the behalf of overseas depository? The an Indian custodian. Option B is correct. What does the limit two-way fungibility scheme for the ADR GDRs allow? So basically it allows the purchase of shares from the market for the conversion into ADRs and the GDRs. So the option B is correct. And which of the following is true about the disclosure standard for the ADRs issued in the US? So the disclosure standards for the ADRs must comply with the US GAAP accounting standards. Because the depository is entitled to voting rights as it holds the equity shares on the behalf of GDR holders. So we can say here option B is correct. Now what is the minimum average maturity period for which ECBs raised for the repayment of rupee loans availed domestically for the purposes other than capital expenditure? And let me tell about the minimum average. Just tell me what is the minimum average period? Minimum average maturity period. So basically, the minimum average maturity period for the ECB, this is a concept-based question, for the repayment of rupee loan availed domestically for the purposes other than capital expenditure is 10 years. The answer is 10 years. Option B is correct. Which of the following is correct about FDI? FDI is an investment through capital instruments by the person resides outside India in an unlisted Indian company or in 10% more than of the post issue paid up capital or on a fully diluted basis of the listed Indian company. Now what is FDI, madam? What is the meaning of FDI? Foreign direct investments. Basically we can say FDIs is basically when an entity in one company invest in a business, real estate or some productive assets in the another country, giving the investor direct control over the asset. That is FDI. So the correct answer is here option I think both options, option B and A, both are correct. So let me know about which of the following is true about GDRs. GDRs basically represents the receipts that entitle the holder to convert into specified number of equity shares of the Indian company. They are negotiable, they are denominated in the foreign currency, and the exchange risk on the GDR is borne by the overseas investor. So, option B is correct. IDRs are denominated in the Indian rupee or any free convertible currency. I think Indian rupee. What is the minimum average maturity period for external commercial borrowings? External commercial borrowings are the commercial loans for the eligible candidates, and they are the minimum average maturity period is 3 years. Which of the following is the activity in which ECB proceeds cannot be unlisted? Utilized. You have to tell the activity in which ECB proceeds cannot be utilized. If we talk about the list in which ECB's proceeds cannot be utilized, it includes some type of real estate activities. A lot of things are there. Real estate activities, just revise them. Important for question, ignore the face. Okay. Investments in the capital market. Okay. Then equity investment, working capital purpose, except in the case of ECB, and general corporate purposes, repayment of rupee loans, and all lending to the entities for the above activities, whatever I told you. So the correct answer is here all of the above, because these are not proceeds in the ECBs. For where issuance of any type of guarantee related to the ECB is permitted. So issuance of any type of guarantee by the Indian banks, all the financial institutions and the NBFCs relating to ECB is not permitted. Further, we can say here Indian banks, all the Indian financial all the financial institutions, Indian financial institutions, and this NBFCs are not permitted. So the answer is here none of the above. Okay. So now, what is the primary function of the LAF under RBI's monetary policy? So LAF is basically the principal operating instrument of the Reserve Bank monetary policy, while the CRR and SLR help in changing in the stance of the monetary policy on a more permanent basis. LAF is used to monitor day-to-day liquidity in the market. Okay, so here LAF also refers to the lending funds to the banking sector through the repo instrument. I am just hiding myself. RBI also deposits from the banks under reserve repo or the process of purchase and sale of government securities with the agreement to sell back on repurchase respectively within a specified predetermined period. Okay, while banks can engage in repo transactions with other banks institutions, LAF refers exclusively to the repo transactions with the RBI, and bids have to be submitted for a minimum amount of 5 crore and in multiples of rupees 5 crore thereafter. So just tell me now the correct answer for this question. What is the primary function here? So to monitor day-to-day liquidity in the market through repo and reverse repo transaction. And which of the following is true about the variable repo rate which is introduced by the RBI of India, sorry, Reserve Bank of India on February 3, 2015. It provides the liquidity for up to 28 days with a limit of 0.75% of NDTL for the banking system. So the option A is correct. And which of the following is the minimum amount for which bids must be submitted under the LAF repo transactions? I think the answer I told you, 5 crore. Okay, understood? Next question. What is the penal interest bank is liable to pay if it defaults in maintaining daily CRR balance? Read carefully and try to give the answer, and just give me only 1 minute for a water break. Okay, so here four options are given here. So we have to choose the only one option. Panel interest bank. Basically, again, this question is direct related to the concept. Any default in maintaining the CRR balance, the bank is basically liable to pay a panel interest of 3% above the bank rate on the shortfall amount for the day, and if the shortfall continues on the next succeeding day, panel interest here shall be recovered at the rate of 5% above the bank rate. So basically correct option is option C here. Okay, option C is correct. Now tell me which of the following is incorrect about the minimum prudential standards which are required for an AD category first bank to become a trading and clearing member in the exchange traded currency options for of a recognized stock exchange. Okay, following are the driving force I am telling you here of the integrated treasury management. First one is integrated cash flow management, then interest interest arbitrage, access to the global resources, risk management, and corporate demand for high end services. So if you here talking about the incorrect one, all the three are included. This D1 is incorrect here. Okay. Now, the driving force of integrated treasury management are risk management, interest arbitrage, or the access to the global resources, and all of the above. The driving force of integrated treasury. And also the next question. Okay. I think we can say here all the options are correct. And I will tell you about this question. I think there is some mistake in this question, but I will tell you about the this question. I think I'm confused that what is the prudential requirement. Uh, but according to me, here option A will be the correct answer. But we'll tell you after confirming, and also you can tell me in the comment section. And I am little bit confused. Saw the PPT first, this PPT, and I just saw this. So yeah, just tell me. According to me, the answer A is correct, but you also have to tell me. I am telling you that minimum prudential requirements for the AD category 1 bank are become trading and clearing member of the exchange traded currency option market of the recognized stock exchange. And here are some like minimum CRAR of 10%, and net NPA should not exceed 3%, and also minimum net worth of rupees 500 crore. I think the question is incorrect. I'm thinking that, but I will check this. Okay. Which of the following is not correct? Now tell me fast. Which of the following is not correct? Okay. First option, open positions refers to the trading positions where the buy sell currencies are not matched. The limits in the foreign exchange trade are defined as basically daylight and overnight, and also the overnight limits are smaller than the daylight limits, and the position limits are prescribed here currency wise as also for the aggregate positions. Just tell me about this question. Till then, we will move this to this question. Which of the following are the functions of integrated treasury? This question and this question, I will tell you. According to me, here answer A is correct. Just tell me I am correct. I am correct. I am 100% sure. And for this question, I am saying that the answer which is correct is option A. But I am here a little bit confused. But okay, I will check about this. Okay. Now, which of the following are the functions of treasury? I already told you in this class about the functions of treasury. Just tell me. Okay. Read all the question carefully. Then we will deal with the those two questions. Basically, if we talk about the integrated treasury functions, first one is meeting the cash reserve requirement, that is CRR and the SLR. Then global cash management, risk management, that is managing the market risk of the bank, and also assisting the bank management and fund transfer pricing. So option D is correct. Then if we talk about here, open positions refers to the trading positions. This is, I think, correct. And second one is here, the limits in foreign exchange trade are defined as daylight and overnight. This is also correct. But the overnight limits are larger than the daylight limits. That question, I think, is, that option is incorrect. Okay? That option is incorrect. I understand now. I'm just little bit confused between these two three slides, but okay, now all set. Before, if you all still face any problem, just tell me. Okay. Before setting a deal, the back office ensures that, see, whatever the deal is here with the exposures limit allowed by the counterparty. Okay, the back office is responsible for confirmation, for accounting, and for settlement of the deals. The back office also obtains some kind of independent confirmation of each and every deal from the counterparty and settle the deal only if it is within the exposure limit allowed by the counterparty. So option B is correct here. What is meant by high leverage? What is meant by high leverage? Basically, the treasury has a very low funding requirements, very low funding requirements, that is called as high leverage. So option A is correct. Okay, and treasury can buy and sell the foreign exchange of value rupees 100 crore without any direct investment of funds except for the allocation of risk capital as per capital adequacy requirement of RBI. Who is responsible, which office is responsible for middle office? MIS here, for management information system. I think middle office is here the answer. Middle office, banks have a middle office which is responsible for risk management and management information system, and this middle office would ensure treasury compliance with the board approved policies which are bearing upon the forex risk management and the investment management and the liquidity management. Option B is correct. Okay, so a citizen of which country requires the prior government approval to invest in sectors activities other than defense, space, atomic energy, and the sectors activities prohibited for the foreign investment? So answer is clear, Pakistan. Without any doubt, Pakistan, a citizen of Pakistan or any entity which is incorporated in Pakistan requires the prior government approval to invest in these sectors. Okay, so option B is correct. Understood? If you are enjoying the session, kindly give the like, to the session. Okay. Moving to the next question. Okay. What are the two reserve requirements that Treasury has to comply with? What are the two reserve requirements that are CRR and SLR? Integrated Treasury in banking setup refers to. Tell me about this question. Okay. If we talk about the integrated treasury in the banking, basically, correct definition of integrated treasury in a banking, it involves consolidation of the operations which are related to the money market. Okay, money market instruments like treasury bills, securities market, and foreign exchange operations. This integration allows for centralized decision making, improved risk management, and the better profitability by efficiently utilizing funds across these markets. So the option D is correct here. Which of the important operational feature of integrated treasury? See, an integrated treasury basically in banking involves multiple operational features that enhance its efficiency and the effectiveness. And if we talk about having a common dealing room is also an operational feature of integrated treasury. Then having a common mid-back office, this is also an important operational feature for the integrated treasury. And if you are reading the option C, this looking for internal interest arbitrage across currency market to be positioned to shift swiftly, this is also the correct option, correct requirement for the integrated treasury. So we can say all of the above options are correct. Okay. Treasury in the normal course will manage all funds raised through deposits, all the deployments of funds through advances, liquidity, ALM book, merchant book, and the trading book. Basically, this asset liability management. This involves banks' balance sheet, which ensures that assets and liabilities are structured in a way that balances the risk and return while managing liquidity and interest rate risk. So option D is correct here. Globalization refers to, I think, which option is correct? Question is repeated again, but new type of options. So the option D is correct. You can see the process of integrating the domestic market with the global market characterized by the free capital flows and the minimum regulatory intervention. All the exchange rates quoted on the screen or imprinted are for dash unless otherwise mentioned. Spot transactions. Forward rates fully reflect interest rate differentials only in the perfect markets where the currencies are fully convertible and markets are highly liquid. Forward exchange rates basically reflects the interest rate differential between two countries, two currencies which are based on the principle of covered interest rate policy. So the option D is correct. Nostro account. Nostro accounts are Nostro accounts are, I already told you yesterday, a account that a bank, important account, Nostro, Ostro, Loro, Mirror, in which basically bank holds in a foreign currency in the another bank outside its home country. So basically, current accounts that are denominated in the foreign currency maintained by the banks with their correspondence banks. Notice money refers to, I told you, the placement of funds overnight, not be exceeding 14 days. And the salient feature of convertible bond. What can be the salient feature of convertible bond? Basically, option to convert into a equity on a fixed date or during a fixed period, and the price is predetermined. GDRs. Here, what are GDRs? Global Depository Receipts. These are type of a financial instruments which is basically used by the companies to raise the capital in the foreign markets. They are issued by a depository bank overseas, and yes, negotiable receipts which are issued by an overseas depository representing prefixed number of equity shares of an Indian entity. IDRs are denoted in Indian rupees. ECPs can be raised in, I think, any free convertible currency including Indian rupee. Okay, now which of not following is not true in the respect of trade credits? Let me tell about this. Okay, which of the following is not true in respect of trade credits? Four options are given. Trade credits. See, here we can say domestic banks cannot guarantee repayment of trade credits. This statement is not true. Why? This statement is the answer. Why? What is the meaning of trade credits now? Trade credits are basically referred to as a short term financing arrangement. Financing arrangement where a buyer is allowed to purchase goods or the services and defer the payment for a specific period. They are commonly used in the international trade to facilitate the transactions between importers and the exporters. The exemptions from the DTL include, okay, this question is skipped, the components of broad money market, broad money. Basically, currency in the circulation refers to the physical cash. Demand deposits with the banks, these are the deposits that can be withdrawn on demand without any notice, and also time deposit with the banks and the post office saving deposit. These are the components of broad money. That means option D is correct here. The exemptions from DTL. The exemptions from DTL. DTL means that is depository target level. Depository target level. Depository target level is a regulatory measure that affects the liquidity and availability of the funds for the banks and the financial institutions. we know, and we can change the accent of our language. So the exemptions from the detail include transactions with the tri-party repo GSEC with CCIL. This option is correct because the transactions in the tri-party ratios, especially it involves government securities, are exempt from the detail, and they are having considered secured and short-term borrowing arrangements, which are important for the liquidity management. Okay, now the liquidity corridor that RBI used to, RBI used to, where is the slide? Okay, to control short term interest rate is defined, dictated by MSF, SDF rate, call money market, bank rate, or SLR and CRR. Basically, correct answer is MSF and SDF. But what is this MSF and SDF? MSF is marginal standing facility. What is this? This is the rate at which banks can borrow the money, banks can borrow the overnight funds from the RBI by pledging the government securities. It also serves as the upper limit of the liquidity corridor. And this SDF, this is basically standard deposit facility. This is the rate at which the bank can park their excess funds with the RBI overnight without any collateral. It acts as the lower limits of the liquidity corridor. That means our option A is correct. Okay, now RTGS has been fully activated by RBI from dash, where the settlements are on dash basis rather than day and dash settlement of checks in clearing house. RTGS, real time gross settlement, which is fully activated by RBI in October 2004. This means transactions are settled on a gross basis. Okay, gross basis, and this is in the contrast to the net settlement of checks in the clearing house. That means our option B is correct. Till then, tell the answer of this question and give me a second. The following facilitate delivery versus payment for secondary market deals in equity and debt paper. Okay. Basically, if we talk about the sorry here, NSDL and CSDL. And what is this delivery versus payment? Is a settlement mechanism which is used in a financial market to ensure that the transfer of equities occur simultaneously with the transfer of funds. This minimizes the risk of default by either party. So we can say here the correct answer is option C, that is NSDL and CSDL. Okay. For ensuring effective risk control, RBI expects banks to facilitate functional segregation between So the correct answer is there: front office, mid office, and the back office. These are the required. RBI expects banks to facilitate functional segregation. The most important and well pronounced risk in treasury is market risk. And what is the market risk? Market risk when the fluctuations are there in the market. This is the well pronounced and most important risk. The the following limits in treasury are meant for controlling the market risk. The following limits are treasury are meant for controlling the market risk. Basically, in treasury operations, various limits are there which are established to control the market risk, which arises from the fluctuations in the market prices, interest rates, and the foreign exchange rates. So, if we talk about here, the correct option, the intraday, uh, overnight open limit, position limit, and stop loss limit. These limits are defining the maximum amount of exposure a treasury can hold at any given time, both during the trading day and overnight. They help in managing the risk associated with the holding positions in the volatile market. So the correct answer is option C. Okay. Now, value at risk is a statistical measure to capture value at risk is a statistical measure to capture this is a statistical measure which is basically used to quantify the risk of loss on a portfolio of assets. So probable loss in portfolio with a time horizon at a given confidence level. So option B is correct here. Yield and price of a bond move in an inverse proportion. And the value of derivative is determined by the value of underlying notional principal amount, FIMDA, FEDAI. Basically, the value of a derivative is fundamentally linked to the value of underlying asset. Derivatives are the financial instruments, we know that. That value is derived from the performance of an underlying asset. So basically, we can say here option A is correct. And we know that what is the meaning of FIMDA and FEDAI? FIMDA is fixed income money market and derivatives association. And what is this FEDAI? This is foreign exchange dealers association of India. Okay. What is the essential difference between an OTC and exchange traded derivative? See, OTC derivative, over the counter derivative, which are privately negotiated and traded directly between the two parties without any type of exchange. This leads to significant counterparty risk, which is the risk one party may default on its contractual obligations. So I think C option is correct here. Okay. Now, in case of free currencies, forward premium or discount is exactly equal to the difference of this is the in case of the free currencies, forward premium or discount is exactly equal to the difference between risk free interest rate of the two currencies. So the option A is correct. Okay. Now, and put option is in the money is and put option is in the money, and put option gives the holder the right but not the obligation to sell an underlying asset at a specified strike price before or at expiration. So here we can say the answer is the strike price is more than the market price. And in India, market for currency futures commenced in August 2008. Okay. Liquidity risk is reflected as the maturity mismatch, because we know that liquidity risk, there is a gap in the cash inflow and outflow. Basically, liquidity risk is the risk when there is the bank is not able or entity is not able to meet its financial obligation as due with the incurring significant losses. Now, derivatives can be hedge aggregate risk as reflected in the, I think now visible here. Derivatives can be used to hedge the aggregate risk as reflected in the asset liability mismatches. This case, a dynamic management of hedge is necessary because here derivatives are often used to hedge against the risk that arise from the mismatches in the asset liability structure of an organization. This requires a dynamic management of hedge for the following type of regions. But the composition of asset and liabilities is always changing. So answer is option C. Okay. Option C is correct. The participants in derivatives market generally exchange the following agreement with the ISDA, that is the International Swaps and Derivatives Association. This is the organization that basically aims to promote the use of derivatives in a safe and efficient manner. Okay. So the credit derivatives segregate dash from the assets through the instruments known as dash, as transfer the risk from the owner to another person who is in the position to absorb the credit risk for dash. See, credit derivatives are the financial instrument which are used to manage and transfers the credit risk which are associated with various types of assets. First one, credit derivatives segregate the credit risk. Okay. These are designed to segregate the credit risk from the underlying assets. And these instruments known as CDS, credit default swap. One of the most common type of credit derivative is credit default swap. Credit default swap, basically this is a contract between the two parties where one party pays a premium to another party in exchange for protection, basically in exchange of in another party for the exchange of protection against the default of a borrower or the bond issuer. and the owner to another person who is in a position absorb the credit risk for the fee. Obviously fee is required, so the option basically here B option is correct. Okay, now all the top MCQs we completed. As you can see, we have completed today 111 questions. We can say more than 100 questions we covered today with the concepts here and with the things. We covered all the things today, and I hope this today's session is helpful for you, and thank you so much for attending this session. I hope you like this class, and if you like this class, kindly give the like to this session. And yes, any type of feedback, any type of appreciation is always acceptable, but yes, feedbacks are also acceptable. And if you like this session, kindly give the like and subscribe to this channel. We will meet again with in the next class with some most important MCQs of module D, and then we will discuss on the case studies and the numericals, and then final marathon will be there. So thank you so much class for attending this session and watching this session. Thank you everyone. We will meet again at the